Welcome to the MD podcast with me, Martin Hartley. I'm the commercial director of Imagine. Imagine are a professional services consultancy, and we specialize in high volume, low population SMEs to the banking and financial services sector. Being a leader within the world's leading financial organizations is aspirational. However, few people make it to the top. The Imagine podcast will offer interesting, insightful, and frank discussions on the biggest issues facing directors and divisional leaders in the financial services sector. The show aims to inspire and educate future leaders by telling the career stories of today's leaders. I can't wait for today's episode. I'm joined by Alaistair Sharp, Managing Director of Credit Suisse. Welcome to the show, Alaistair.
Thank you very much.
Good. All right, so as the listeners know, we look at the past, the present, and the future. So let's take it straight back. Tell us a little bit about yourself. Where are you from?
Well, I was born in Jamaica to a Jamaican family. My family were originally from the UK, from England in Yorkshire, but back in the 17th century, and they were royalists, and so they migrated to Barbados as sort of economic migrants after the Civil War. And so they were in Barbados for generations, and then moved to, my great-grandfather moved as a teenager to Jamaica and started growing citrus fruit. Well, he originally was a cane farmer, but he started growing citrus fruit, and his sons, my grandfather and his brother, started a company called Troutall, which grows a fruit called ugly fruit, which some people might know from over here. My parents, my dad went into the business, and my parents decided when I was younger that there were not very many suitable schools in Jamaica, so they sent us to boarding school in England. And it's that that's sort of given me the basis, the education to end up where I am today.
Yeah.
I went to boarding school in England, then Edinburgh University, studied mathematical physics, joined the JP Morgan, in fact it was called Chase back then, in 1996, subsequently moved to RBS in 2001, and then on to Credit Suisse in 2012. And here I am today.
Excellent. Okay. So why financial services then? Where did that aspect come from? Assuming obviously your parents weren't into that sort of thing.
Yeah. So I mean, one of the great things about my sort of upbringing to my dad was off in America working after an MBA at Cornell, and his grandfather, his uncle told him that he had to come back home to Jamaica to work. So I think it sort of put into him a sense that, we shouldn't really force people to do things that, they don't want to do. And he always just said, listen, as long as you contribute, I don't mind what you do. As long as the job you do contributes to the world, I'll be happy. And so none of us were pressurized into this. None of us have, in fact, gone into the family business, which is a sort of a great shame. But it meant that we were all able to pursue the careers we wanted to. And I guess I wasn't so sure. I was more interested in science and also being a teacher. So that was sort of my aim when I was at university studying physics. But as that sort of time went on, I sort of discovered perhaps not. Perhaps I wasn't quite good enough or quite interested enough, I suppose. And my brother had started at Credit Suisse in 1992, I think it was, and was a trader. And so, started telling me about it, and it sounded very interesting. And so I, applied back in, I don't know, probably, maybe as late as 1994 or 95, got interested in it. So, the routine was much easier back then. 96 got the job, and from there I, moved on into trading, and this is where I am.
Okay, gotcha. So you had your brother there giving you some information and some tips on what it was like and what it was like to be in that sector, in that industry.
Yeah, and I suppose also what I didn't really understand what financial markets did and financial services did back when I was a teenager. Mm-hmm. I thought they were sort of like a zero-sum game. It's sort of it's sort of gambling. If someone wins, someone else loses.
Yeah.
And I came to understand that actually it's a service that basically it's actually it's profit for both sides. What the money I make on the trades I do is good for the Credit Suisse where I work, but equally well the hedging that the clients of the bank do, all right, allows them to do more of the business that they are specialized in. So insurance, manufacturing, etc.
Yeah. Yeah, exactly. You're able to facilitate other parts of the business, aren't you?
Yeah, I mean, so the economy would be much poorer if we were not here to provide these financial services, which allow them to mitigate their risks, their business risks.
Yeah, absolutely. So talk us through your entry role. Talk us through that application process, how you got the job. What was it like?
Well, like I said, it was much easier back then because you didn't have to have a long sort of CV of showing interest in
Yeah.
financial services. I mean, I look at some CVs nowadays and I'm astounded by how much people had to do. They're barely allowed to be children and having fun. I understand it's competitive, and so you have to show that you're interested in that, and that's fair enough. But for me, it was a bit easier. I did get a bit of work experience. I worked at a couple insurance brokers, Lloyd's brokers.
Yep.
And sort of started to get a taste for what I might want. I sort of initially at that time I thought maybe I'd be an underwriter. Okay. And then I suppose that sort of underwriting is a similar sort of job as trading. It's sort of risk management, and that's, I guess, probably the genesis of my thoughts about becoming a trader. So that would have been in like 95. So about a year before, or 9 months before I got the job, a year before I started. And so I applied through they used to be called the milk rounds. All the banks would come up to, and you go along and meet the people there and find out about it. You apply, and I was selected for a selection weekend down in London with Chemical Bank. In fact, it was because in fact they hadn't merged it with Chase Manhattan, and that was a two-day selection process, and I got a job on the back of that. But by the time I joined, it was called Chase Manhattan.
Nice. Okay, a couple of things I want to touch on there, because it'd be really interesting for the listener group, the audience, of aspiring MDs. You mentioned obviously it's a lot easier for yourself, and nowadays the CVs that you get, they're littered with extracurricular activities or interests before they even got to the point where they can actually work. How did you go about getting your work experience, and how important is that in the role of getting a job, an entry-level job into the financial sector?
Sorry, it froze again in the middle of that question. Sorry, can you?
No, yeah, I was repeating the question. I was just saying, how important do you think it is to have that that prior knowledge, or the work experience that you had when entering the market then compared to now, and what tips would you give to the next generation coming through now?
So it's much more important now. I mean, I'll just take, for example, I do quite a lot of intern interviews.
Yeah.
And I don't mind if someone comes from a background where it's not all that normal and they haven't had the exposure. So for example, if the only job you've had is working in the pub, all right, but you demonstrated that they gave you a shift because you're responsible, and you shown sort of ambition and application and thoroughness and what have you, professionalism, then that's the sort of things we're looking for. Obviously, we prefer it from a relevant job, all right. And we'd also like to see that that there's a genuine interest in the job, right? So actually, having worked in finance before, you can ascertain get a clearer picture about whether or not they're going to be interested in the job, because you only become good at a job if you like it.
Yeah.
It doesn't matter how clever you are. Nobody can apply themselves so high, with the right amount of application, if they don't enjoy the job. So it does help to have had these jobs before, or have relevant work experience. But if you weren't exposed to it and there's a good reason why, then I'm very forgiving of that, because if I grew up and my dad was a banker and my brother was a banker and stuff like that, and and sort of I got sort of pushed into work experience here and there, it does very often that person doesn't want to get into it. Sort of going back to the situation of my father being forced to go into agriculture. To be honest, he's had a great life with it. He's liked it, but he actually didn't want to force us into that, because I suppose because of what happened to him. So you don't, I don't want to see somebody who's, or rather, if they've had work experience sort of handed to them on a plate, they have to demonstrate a bit more than just that their CV has these things on it. They have to show genuine interest.
Yeah, okay. And how, similar question, but around education, like how important is where they went to school, or what degree they did, or which university they went to nowadays?
Well, I think where they go to school is probably not important at all.
Okay.
Right? I mean, I don't vet the initial CVs, but I certainly don't remark on where they go to school. I'm not interested in looking at that. I look at what their A levels were, all right, but even that is not so important. It's, I guess the course they're doing, yes, matters. I suppose, a mathematical aptitude is important, but actually, I think, if you did classics, if you did history, if you did Spanish, modern languages, if you did physics, they're all suitable degree courses. And as long as they're sort of at a competitive enough university, I don't need people to come from Oxford or Cambridge.
Yeah.
I guess the industry as a whole does tend to favor universities like Warwick, Oxford and Cambridge, London universities, and the such, like Edinburgh University as well, where I went. It does, but I don't, it's not so important to me. And I find that the best CVs, what looks best on CV doesn't often lead to the best candidate when you meet them. So, there's plenty more in the CV. There's there's their work experience and what have you, and also their extracurricular stuff. A lot of people nowadays do day trading or societies and stuff like that, so that can demonstrate their suitability and interest in the job.
Absolutely, good. Okay, nice. Some good early tips there for the next generation that are coming through. So you started, it was Chase. What was it like? What was the first day on the floor like?
I mean, it was pretty good like back then. It was, it was pre-Euro, so there were far more currencies. It was much wilder, yeah, probably we shouldn't talk about everything that went on, but nothing bad or illegal, just sort of a bit more raucous and noisy.
Yeah.
As a trainee, I remember sort of getting people's breakfast, getting sort of 3 trays of breakfast for the entire desk and stuff like that. And those sort of days are gone, and thankfully so. But you sort of earned your stripes, and then there were lots of opportunities. And when one came up, you took it, and you sometimes never look back. But there was tons of great traders there who are now at big hedge fund managers and stuff like that. So it was a great place to learn. Lots and lots of pretty bright people, and people have become very successful. Have come out of that sort of crop of people at Chase.
And what if thinking back then to that job, say the first 2 years, what did you do that you think, okay, you did differently to some of your peers, or maybe you all did it and you've all gone on to become successful? It doesn't necessarily have to be different, but what were you doing there that you think people of today should be doing, should be copying what you did, because actually that gave you a competitive edge, actually like that made you stand out?
Well, I suppose, what I've done in my entire career, and it's also what I advised, the one piece of advice to interns when they ask sort of, how you've had such longevity in your career, is basically constantly change your business model.
Okay.
It's no good just offering the same thing that you offered before, because, once, if let's just say I come up with a new plan and a new way to do things and everyone else learns how to do it as well, I'm no longer competitive, and I have to be able to offer someone else something new to them. So it's basically always making, and what I say is just make sure whatever you figuratively sell to somebody is worth more to them than you get for it. That benefit is imparted on that person, and that way you've got a guaranteed career, because people will still want to come back and buy your services from you. So I guess I just made sure I was constantly reassessing the value I was adding. Yep. And trying to change my model, sort of, so somewhat like an A/B testing sort of thing.
Yeah.
To make sure that, I was always relevant.
Nice. And is there anything you did internally? So not necessarily anything to do with the clients, but asking for could be things like asking for promotions or asking for further training or extracurricular study.
I mean, there was a bit of training, but with trading, it is so much more sort of on the job sort of training or on the job experience. I guess the key is to chat amongst your colleagues. The more senior traders have a wealth of information and experience, and the so-called 10,000 hours when you're just starting off your career. The edge that you have as a young kid is you're sort of technologically more advanced than them, let's say, or rather they're bright enough to do it, but they don't bother because they rely on the sort of experience that they have. And I think it's the same now. I mean, it was the same back then. I was writing spreadsheets for the guys I was working with, for the senior traders and stuff like that. Nowadays, the young guys will come in and do similar things, or bring in some sort of like analysis or something comparable to that. Come in with a new sort of means or way of doing something that is a bit more technologically advanced, but because they don't have the same you can't just copy exactly what the person who's 10 years more experienced than you does, because you don't have that experience.
Yeah. You cut out slightly just halfway through that,
Okay.
but you came back in there. So
should I go start again, or?
No, it's fine. It's fine. We got the gist of it, so it's okay. Looking at, obviously you were there for 4 years and 7 months, and then you made the move. Why did you? How did that come about, and what was the thought process there?
Well, it was an enforced move. I was made redundant in the merger with JP Morgan. I just basically moved across into the emerging markets desk from the sterling desk because there was an opportunity that was potentially going to come up. And in fact, it did come up, but it was on the Polish desk. But unfortunately, by that stage, we were merging, and they had two traders who traded the Polish curve at JP Morgan. So the job went to the guys who were already doing the job.
Gotcha. Okay. So you move over to RBS. How was that? What was your role there?
It was back doing sterling, very similar to what I started out on at Chase. It was a very similar place. In fact, there were quite a few people who had worked at, well, both Chemical Bank, but mainly Chase Manhattan before the pre-merger. So it was a very similar shop, very strong rates franchise, and for lots of people, I mean, in sterling, for example, at one time, there were 3 of us doing the exact same job. This is whereas in some banks there's one guy doing 3 currencies.
Yeah.
You know what I mean? So it was a huge rates trading house, and it was a great time to be there. Very profitable. I learned a lot, and it sort of helped. I think I probably learned more and improved more when I was at RBS than when I was at Chase.
Okay, interesting. Yeah, because they're still very strong on the rate side, more just on the trading aspect of it now, but they're still got a good reputation there. What in particular was it about that environment then that helped you to progress your career?
I mean, there are a few things. The one thing that really helped was the boss that we had at the time, Steve Ashley, just about the credit crunch time. So that's quite a few years after I'd started there, but he was a trader, and so understood trading and risk, and gave you the scope to do your job. A lot of managers that I've observed in my time in trading or in a rates world weren't necessarily the greatest traders, and that's not to say that they shouldn't be managers, because the greatest traders don't necessarily make the greatest managers. But it did mean that from a risk management point of view, they didn't always make the best calls. And I think, I'm of the opinion that, the trader is ideally placed to make those calls. That's what they're paid to do.
Yeah, exactly. Yeah.
And so, and the point is, he understood risk, and so he let you get on with it. But he was competent enough to know whether you need, the controls that needed to be in place, because obviously you can't let, people go on without any controls whatsoever.
Yeah. It's an interesting topic though, isn't it? Because of what you've just described there about the managerial route within the trading world. Typically within a sales environment, the best performers get promoted to be the managers, but they don't necessarily make the best managers. So you always sort of have that
Yeah, I mean,
question mark.
I think the industry probably didn't, 10, 20 years ago, hadn't properly worked that out, and didn't, and maybe got it wrong, or I think got it wrong, because the most profitable trader did become the manager. But costs and working out costs weren't as important back then. Maybe profit margins were much higher. They weren't the same sort of regulatory charges that we have now.
Mm-hmm.
We don't have as much compliance and operations costs, and so it was a lot easier to manage back then, I guess, because your cost base was a lot smaller.
Yeah, that's certainly.
And I think the problem is the job of trading is, we become good at this job of trading because of a few things that we quite like about it, right? And the job of managing is entirely different. And so the fact that you're a good trader is probably because you really enjoyed the sort of the pros of trading, and they don't really exist. Those particular pros don't exist in the managerial world. So unless you also have that, you don't really thrive as a manager.
Yeah, it goes back to what you're saying. You've got to be passionate about something to be good at it, right? So you've got to really be passionate about your people in order to be excellent at it.
Yeah, I mean, I think it's more than just being passionate about the people, because you obviously do need to be that also. But it's got, there's very low admin as a trader, and management has much more admin. And now in the higher regulation times, there's much more regulatory responsibility you need to take on, and you have to look at your cost base much. Maybe we should have been doing it all along, but it is far more important nowadays to results, to the bottom line. So it's these things that are, for want of a better word, less sexy and less sort of like exciting.
Yeah, exactly. But mandatory for the role.
But not just mandatory, important, totally important. You know what I mean? And I suppose as well, if it depends when you're managing as well. If you're managing in a world where everyone's expanding and that's the job, it's sort of like recruiting. That can be fun. If you're managing in a world where the business as a whole or margins are tightening and you're retrenching, and you're having to cut costs and stuff like that, it's a different thing. It's not as much fun, to do that side. You're not building a business. You're perhaps, making it endure, but not necessarily, creating, extra jobs.
Yeah, it's a different skill set, but it is a skill set.
Absolutely.
Okay, so let's talk about 2008. Around that time, then you've been in the career 12 years now. You're good at what you do. You're confident, and then obviously we're going into to darker times. Talk me through that experience, that phase of your career.
Yeah, well, I suppose that actually started in 2007, because for us, it really started in 2007. I think it was July or August. Overnight, rates blew out by, I don't know, 50 basis points or something like that. And then it led out into the 1 month, 3 months, and 6 month plus 1 year tenors. We just had unprecedented moves, in rates. The fixings were moving up at 30 basis points a day. You really didn't know, one side of it, you didn't really know what was going on. It was sort of like, wow, can it really go up there? And I guess you didn't also know that actually there are all these firms that could potentially go bust. And I worked at RBS, which essentially, went bust.
Yeah, exactly.
But was bailed out by the UK taxpayer. I think at the time, you sat there and you're doing your job, and you're not really concentrating on that side of things. You're concentrating on your job, making money for the firm, and risk managing your positions and providing prices to a whole host of new clients that needed to, suddenly worked out that they had risk that needed mitigating.
Yeah.
Prior to that point, no one really understood properly that LIBOR and risk-free rate were not correlated. All right. And because by and large, they were correlated to a high degree, and suddenly they became totally uncorrelated, and, people suddenly were scrambling to protect themselves. And, we saw the Northern Rock go bust because of that. And Lehman obviously in the end went bust as well. It suddenly also, the numbers you were looking at, the P&L sort of like ballooned by, 10 times what people were making and losing in a day. So you sort of, sort of had to grow up, as it were, I think, get used to a lot more pain and a lot more profit in a very short period of time. But like I said, the boss at the time, Steve Ashley, who was fantastic, he gave you the license and he believed in you, so he allowed you to do your job, and because of that, the desk as a whole and the whole floor at RBS at that time, were very, very profitable. It was scary though, because you were sitting there and you knew a lot more about how close the world was to financial collapse. I guess I have a different opinion on things than a lot of people outside of the city. The bankers up after that got a very bad rap, and I what I guess a lot of people don't realize is just how much those bad bankers that lost all the money are hated by all the rest of bank employees, because what they were doing was totally outrageous and irresponsible. But the job that the vast majority of people in financial markets do is productive and helps businesses mitigate their risks. And you're just sitting there seeing more and more and more cases where you thought the world could just collapse. We could be sort of getting arms and sort of civil war.
What was the atmosphere like on the floor in those times? Were you trading? Were you worried when you were trading? Did it come into your thought process, or were you in the zone and it was just no?
I guess there were a lot of the time we're in the zone. I did have some bad days. I mean, two out of three of my very worst days were in those sort of first few months of the crisis. And I actually remember one day I lost more money than I'd ever lost before, and I was just so distraught. I don't want to say I wanted to kill myself, because I definitely didn't, but I think I might have wanted to quit.
Yeah.
And I called my brother, who was in New York, and spoke to him, and he just said, "Listen, it'll pass. Just go home, go to bed, forget about it, come back tomorrow, it'll be better." And it was, and I think that has helped me as well, because in my time of managing guys who worked for me, I had a trader who had a very bad sort of event happen. He lost quite a lot of money on some extreme moves, and I was able to sort of share my experience with him, to sort of say, "Listen, I understand what you're going through, and this is how it worked out for me, and I know it doesn't feel like it, all right, but it's all going to be fine, and don't worry, you're good at what you do. I know you feel like you're rubbish. You feel like you that maybe we don't have confidence in you, but I still do. Don't worry, And so I guess having gone through it myself, it was easier for me to manage this guy when it happened to him.
Yeah, and I think that's a really important aspect, isn't it? Is a positive affirmation in a time of crisis is when people need it most.
I mean, I essentially say to everyone, every cloud has a silver lining. I know it's a bit of a cliche, but it does. And on top of that, it's, even if it's the worst loss that you've ever had before, there's a lesson that can be learned from it, and you can pick yourself up and come back better and stronger. I mean, obviously you'd rather those losses be smaller. Like, I mean, for example, I say to all the graduate trainees when they're, they say, listen, I know you want to make money, all right, but if you lose money, all right, you will do, and you will lose money at some point, all right. I think you'd probably rather it be a small amount when you're, starting out than a massive amount when you become a really experienced person, because, you'd rather lose 25 grand than 250 grand, or, 250 grand than 2.5 million, or what have you, So, it's every little setback should be looked at as an opportunity to learn, to teach yourself, how to become better. And, that's the sort of lesson I try to teach them when these things happen. And boy, did we learn some of those lessons back in 2007 and 2008.
Yeah, and quickly.
Yeah, and quickly. Yeah.
Nice. Okay, cool. So then you're there for you're there for 11 years. So I was about to say 9 years. I've been at CS for 9 years now. So 2012, you make the jump to CS. Any particular reason behind that?
I guess I saw the writing on the wall for the institution. The government ownership, and the management in place, understandably wanted to take the bank away from investment banking, from what the press like to call casino banking. I disagree vehemently, because I hate gambling. I don't gamble ever, all right, and I don't see what I do as being gambling. But I saw the writing was on the wall. I saw that, like I said earlier on, we had 3 people who did the exact same job. So I expected that, in the next few years, 1 or 2 of us might be made redundant. In fact, in the end, I left because a friend of mine who was at Credit Suisse, a really nice guy, was doing my job at Credit Suisse, but wanted to sort of like move internally. And so he was like, listen, are you interested? I can't think of anyone better than you to come and do this job. I knew him, and I knew that the other guys on the desk were quite good lads, good atmosphere. And, so I thought I'd move, because it seemed that Credit Suisse were, looking to expand in this area, and I thought that RBS were not, and I guess I was right, because everyone's been made redundant from that desk at RBS now. And yeah, no, here I am, sort of 9 years later. Very happy that I've moved across.
Nice. Okay. How long were you at CS then until you were promoted to managing director?
I guess about 7 years. I was eligible for promotion quite a bit sooner, but I didn't see any purpose or need to do it. I believe that so much of promotion, or people's desire to be promoted, is based around compensation and around sort of being in charge of one's own destiny.
Yeah.
And as a trader, you're largely in charge of your own destiny right from the start, which is why I love the job so much. So, from back when I was, young 20s at Chase, I was calling the shots in what I did. Essentially, I'm the manager of a small business within, the firm I'm working at. Yeah. My boss doesn't tell me what trades to do, because otherwise he might as well just do them himself. So, I buy and I sell, and I, hedge and I don't hedge, or what have you, according to what I believe in and and my own decisions. And so you don't have that imperative. And compensation wise, you can be compensated just as well, if not sometimes better than managers. So there was no need for me to get that sort of mark of honor, as it were. But what happened was in 2016, 2017, well, mainly in 2017, quite a lot of the guys left. And in fact, everybody bar me, because we were going through a lot of restructuring, and so it was just me. And I sort of made a decision. I guess I had to make a decision: was, do I stay or do I go as well? And I decided to stay, because I wanted to rebuild the business and sort of leave some sort of legacy if I ever were to leave. And it was that sort of time when I thought, okay, now I had to go out and employ some people. And then once I had them, I had to manage them. And then in 2018, I think it was, or 2017, 18, yeah, I'm sorry. We then restructured again, and the sort of long end rates business, the part I wasn't part of, I'm part of the short end interest rate trading group. The long end franchise business retrenched as well, and I was put in charge of that as well. And so I want, in order to have the right sort of platform to manage that, I thought it was important that I then went for my MD-ship, because unfortunately, quite a lot of people look at your job title or who you are rather than what you have to say. I mean, it's, look at it like Twitter. If a celebrity says something, people listen. If somebody else says something, no one listens. And it's not based, so it's not the content that matters, it's who's saying it. And so I felt I had to be promoted to MD because I needed to be able to represent my business and be able to, get things done.
Yeah, nice. Okay, there's some interesting stuff there, isn't it? It's so, although it was never on your agenda, it was not something that you were writing your own destiny, you're writing your own paychecks, you were having fun, you were making serious decisions yourself. But there's also a form of respect that comes with that title that allows you to make those decisions and be heard, which is quite interesting. Go ahead.
Yeah. I mean, completely. That's it's essentially that. It's sort of once you have the title, people you're able to, doors can open to you. If you ask for something, people respond a lot better, and that's part of getting the best out of an organization is having a network and having people who you can get to do things for you. I mean, obviously you do things in return for them too. It's not a one-way street, but you need to be able to effect change and make decisions that impact the business.
What did you have to do to become an MD? What was the process?
Well, I guess there's a vetting process. There are quite a lot of interviews. You have to fill out a massive questionnaire. Basically talking through your career. I guess pointing out your benefit and strengths for the business, what you've done. And they want to see things like that you sort of uphold the sort of the ethical values of the business. Credit Suisse is quite strong on charity, so any charity work you've done. I also do quite a lot of recruitment for graduate recruitment, with interns, and then I suppose your performance, how much money you've made, who you manage,
demonstrating capabilities.
What their performance demonstrate. Yeah, exactly. Because essentially all the MDs are the people that drive the business forward and drive profitability for the business. So you have to demonstrate that you are one of these people that can do it. Yeah. And so there's a long process of that. There are lots of interviews, and you meet or remotely meet, certainly nowadays, but even back then, because people are all over the world, you have Zoom calls like this with senior managers and the rest of the firm for them to sort of get to know you and find out what you have, what you have to say about yourself and why, what you're looking to add to the organization.
Nice. Okay. So the thought process slightly changed in 2017. You mentioned there you wanted to put some structure and processes in place. Talk me through what was the vision and has that been achieved now? And then on top of that, does the next sort of 3 years look like?
Yeah. So it was basically I wanted to sort of rebuild the business and make it stable, and I think I have. Nice. Nobody's left from the desk, from either the long end or the short end desk in these 3 years.
That's impressive.
And we have a very good. We've also recruited a couple extra people as well. We have a great atmosphere on the desk. Productivity has gone up. We've cut our costs and revenues are up. Things are sort of going well. And sort of, I also brought in a an old colleague, someone who used to work, one of the guys who left in 2016, actually, I brought him back from Nomura, with actually sort of a plan to sort of actually put him into my job, which is in fact exactly what has happened. I've actually stepped back from management, and this guy has taken over. So I sort of brought back in somebody with a view to getting him to run the business. So I kind of feel like, I've done the bit that I could do, or the bit that I was motivated to do at the time. So let's just say if I, decided to go off and live on a beach for the rest of my life, I could go away and think, I've created something that will be enduring.
Nice. You're just going back to the parents' house in Barbados then?
Well, Jamaica now. No, the great grandparents would have been in Barbados. Yeah, no, I'm sticking around in the city, I think, for now.
Yeah,
it's a bit of a pipe dream to think I'm going to be back on the beach.
Okay, and you've got quite heavily involved in LIBOR. Talk me through the reasons behind that. I'm guessing something to do with 2007, 2008. Yeah.
Yeah, well, I mean, I guess so. I mean, it's a benchmark that I've traded my entire career. So over 2 decades, and I think that I wanted to make sure that the direction we took transition in was the right direction. And I felt that I had a lot of relevant experience, because I have a lot of experience of market making, creating markets, and what drives liquidity in markets. I'm one of the guys that makes prices. And I was, back in, I think, 2012, a friend of mine who used to work at RBS with me, but I think at the time was at Nomura, he was instrumental in launching RONYA, which is the repo overnight index average, which is a bit like SONIA, but with the repo, with secured money. And that failed to gain traction. And it was because there was an interest in people using it. They have clients that, our risk is, we trade repo, we don't trade cash. So we want a benchmark against the repo rate. But in fact, there was no liquidity in it because the conditions weren't right for the creation of liquidity in this new index. And so I was there and I saw that, and I learned a lot of lessons from that. And I wanted to make sure that I was helpful and added some value in the transition. And I think I sort of worked out early that people needed a term rate, a term SONIA rate, which is, SONIA is the Sterling Overnight Index Average that is our new risk-free rate that was chosen by the UK working group. And I think that we needed a term rate. Now, this is actually something that has not been adopted, and it's not in the plans to be adopted. In fact, there's quite a lot of resistance to it, because there's lots of worries about conflicts of interest and manipulation, and sufficiency of data, and all the sort of problems that have plagued LIBOR. They worry about this potentially plaguing a term rate for SONIA, and I understand that. But what I think I have an appreciation of that others don't is the end user still wants term rate. It's phenomenally expensive and cumbersome to use a compound in arrears. I don't think it works perfectly because you only find out the rate right at the end of the period. For a whole host of users, that's just not what they want. That's not suitable for them. And so you have to have a convoluted methodology for creating a rate. And I sort of got to thinking about how I could do this, how I could get rid of all the manipulation, conflicts of interest, the so-called inverted pyramid. And I created something called Fairfix, which is an auction for essentially pricing a 3-month rate in SONIA. And it can be used in dollars or any currency that has an overnight rate to create a term rate. and so I wanted to do that. And then I also, sort of from talking to my brother about things, it became clear as well that the risk-free rate was not the correct rate for everybody. The mistake we made, one of the conclusions from the GFC back in 2008 was that, because it seemed that LIBOR wasn't the right rate for people, because LIBOR blew out because banks were, chronically over leveraged, and ordinary businesses weren't, and it was unfair that ordinary businesses, borrowing rates were correlated with bank borrowing rates. When these banks are just uncreditworthy, it's not fair that they're correlated this. And they sort of said, well, the conclusion is that we should put everything against Sonia, all right, or we put risk-free rate. That is the correct and correlated rate to the borrowing costs of corporates. And actually, what was pretty clear last year during the COVID lockdowns was that's not the case, because actually banks are perfectly well capitalized and didn't have any funding issues, but it was businesses, across the world that had to shut down, that suddenly had no revenues, that needed money to pay bills.
Yeah.
Right, and that created a spike in borrowing costs that's only been alleviated by central bank intervention. And so it's clear that the risk-free rate wouldn't have helped these corporates, these businesses, mitigate their financial risks, their borrowing costs. And so, I mean, if anything has demonstrated how important credit sensitive rates are, I think COVID was. The COVID lockdowns was the period that has demonstrated this. I mean, this is despite people, saying things to the contrary. I mean, it could be nothing more wrong than that conclusion. It's definitely they need credit sensitive rates. I suppose more so in the US than other countries. Well, the UK is a very small market. There's, banks, the big clearing banks can perhaps, they have much more stable funding because it's domestic. Because it's their own domestic market, they they have much stabler funding. But in the US, where you have Swiss banks, you have German banks, you have British banks, you have Singaporean banks, all with dollar funding requirements, but no stable dollar funding base. They need to have something to mitigate their borrowing costs, in case of a credit spike.
Yeah, nice. Okay, cool. So where do you see that going? What's your thoughts on it?
Well, I mean, in terms of the credit sensitive rates in the US, they've Bloomberg have come up with an index called Bloomberg Short-Term Bank Yield Index, and that is gaining great traction. I mean, I think for two reasons. One of which is it's a term rate, all right? So for simplicity's sake, businesses are able to just adopt it as a sort of cut and paste with LIBOR.
Nice.
And I think that's, even without the credit sensitive side of things, the term rate would make most end users perfectly happy.
Yeah.
Because then they don't have to spend the millions and millions, and in fact, in aggregate, it's hundreds of billions on transitioning over to a rate that's calculated by compounded in arrears, by a sort of complicated formula. So there's that rate, and then also the credit sensitive side of it means that it is correlated with borrowing costs, and so it better reflects financial market conditions. And so I understand that borrowers might prefer not to have this credit sensitive element to it, but the truth is, with it is perfectly possible to mitigate that and swap yourself back into risk-free rate, and in fact fund at risk-free rate. But it just means that the pricing of that generic credit spread is done in a competitive market, as opposed to a sort of opaque model in-house where, I don't want to say profiteering, but margins would be wider because it's a less competitive environment. So there's that rate. There's a few other, ICE, who are the administrator of LIBOR have something called ICE-BYI, and it's not live yet, but it's the same methodology as the Bloomberg one.
Okay.
In essence, not perfectly, but sort of very high level. IHS Markit have another one as well.
Yep.
Very similar. Ameribor has one that's similar-ish. It's it's got a few more idiosyncrasies, and then there's one called AXI, which is by 3 academics, one of which is Dal Duffy from Stanford University, and they have a commercial partner with a company called Sofa Academy, and they're looking to launch a credit sensitive add-on spread. So it's a spread that sort of adds on top of the SOFR rate. And that uses, this is the most interesting, I suppose, or the most unlike LIBOR, because it uses funding data all the way out to 5 years. So it vastly expands the pool of liquidity for creating this rate. So in dollars, I believe that rate will endure.
Yep.
I don't necessarily believe that it'll be over 50% of the market. I think that if things go as I expect, SOFR will be the dominant benchmark. SOFR will be the sort of the parent curve, as it were, and this one of these other benchmarks will be, a sort of a child of SOFR. Yep. But obviously, if things could change, and if SOFR doesn't get out a term rate for end users to use, it's possible that people could bypass it altogether and just use something like BSBY.
Makes sense.
Unfortunately, in the UK, we don't have that option. Like I said, it's slightly less imperative, but it's very vehemently opposed by regulators and quite a lot of other people. And also the data around to create it is much less available. So it looks for the time being like it'll be something that happens in US dollars, and I guess maybe we'll see whether other currencies adopt that sort of approach further down the line.
Nice. Okay. Well, thanks for that. Appreciate that. Okay. So this is my favorite part now. We'll move to the quick fire questions.
Okay. Let's see how I get on.
What's the 3 pieces of advice you'd give your younger self or the next generation coming through?
I guess to start it off, I mean, it's probably repeating some of what I've said already. I mean, remember I talked about when I lost all that money and I felt really awful. It's sort of like, just pick yourself and get up on with it, because actually the world doesn't end. You can recover. I mean, I know it all now, and I have extreme confidence in myself. And there's nothing wrong with challenging yourself. In fact, like for example, I was made redundant from Chase, and it felt pretty bad at the time, but actually it was probably the best thing that happened to me, because it challenged myself again, and I picked myself up, and I came back stronger.
We'll take that from Peter Crouch's podcast.
Is that what he says?
Yeah, a back stronger element to it. It's probably trending as we speak.
All right. And what other 3 pieces? My gosh.
So resilience.
I mean, so I've talked about resilience. I suppose it's sort of constantly adapt. I mean, I did it, but I suppose I was slower to start off with. Don't become comfortable. Constantly challenge yourself. Ambition is not just about rising up to the top of the organization and being in charge of things. Ambition is about challenging yourself to do better and to create more value. All right, and pushing yourself stronger to do that. And constantly do it. Try not to become, if you ever feel comfortable in what you're doing, you're not trying hard enough. It's a bit like when I used to go to the gym and I had a personal trainer, and I was like, does it never become easy? And it's no, because actually every time it became easy, they just, put an extra weight on.
Yeah.
And that's what you should be doing in your career.
I like that.
And obviously
the aspect. I like the adding value aspect, because it can be anywhere. It can be to a client, it can be internal, it can be to a stakeholder, it can be to a project, a process, it can be anything.
I mean, to be honest, it's in life, you know,
Yeah.
with your friendships and stuff like that.
Yeah, I like that.
And I guess the final thing is networking. It was something I was not fantastic at early on.
Okay.
And I was good at, well, in fact, I was very good at meeting other traders. So I guess it was networking outside the organization, right? But not inside my organization. So I was quite insular inside the organization. And obviously, as I've moved up and become more senior and had to have contact with more people outside of my direct, you know, day-to-day job, right? Especially to influence and you know,
exactly,
affect change, right? I needed these contacts. And what I learned, for example, you know, when I stepped back and handed over the reins to that guy who I'd employed with the view to taking over the business, what I actually learned is externally how willing people were to help me. People who I'd spent time over the years getting to know, having, you know, contact with, I guess, you know, doing favors for people, or, you know, just being a nice guy rather than being difficult. You know, how much you get reciprocated. People are generally happy to help out. You know, if they know you and like you, or have exposure to you. So networking from an early age, an early stage of your career, teaches you how to do it better. All right. You know, so it's no longer daunting, or, you know, it's you expend less energy at doing it, and you know, you get a lot more out of it, and then you reap the rewards, because there's years and years and years of contact and, you know, mutual communication and helping each other to do this. They can contact you anytime they need information on this, that, or the other, and you help them. And you would, when you ask them, that they're equally willing. And when you need things done, you get things done. And it's also like, you know, you call people and say, listen, I'm trying to do this. Who do you know? Right? Because so much of the problem is not knowing the right person to speak to. And that's what networking will give you.
And I think with networking, people think short term. People think, oh, I don't want to go to this event, or I can't be bothered to speak to that person right now. I don't, or, you know, I might feel a bit shy or a bit nervous. But they're not thinking 20 years down the line, when that person is going to grow through their career at the same rate you might be, or quicker or slower or whatever. But, you know, people will be at different stages throughout the career that you can lean on.
Yeah, and I guess that brings up you know, if you want to say a fourth point, is essentially, you know, you got to think long term. It's not, you know, everything is about the long term, and that's what the networking is about too, anyway. You know, it's basically going, right, it doesn't matter if I put profit or not from this thing right now, right? I'm doing something which is A, correct for the business, and B, you know, it's in the bank, essentially. You know, one day I might need to draw on that, whether it be networking contact, or whether it be a piece of information that I read about that is relevant to some financial markets movement, you know, or a skill I learned, etc., etc. You know, you don't need to worry about whether you're going to use it, you know, tomorrow, right? You have to build up that base for, you know, the next 20 years of your career.
Yeah. Okay, next one. 3 resources you use for self-development: books, publications, podcasts, websites.
I read a lot. I read an awful lot of non-fiction books. You know, things like, I mean, it started off with stuff like Malcolm Gladwell, you know, but, you know, tons of other stuff. Kahneman and Tversky, you know, all this stuff about psychology. You know, it's amazing, you know, how important it is, and the things that you learn about how the world works, you know, and so that reading is, for me, has been very important. I do a bit of, you know, sort of formal training as well. You know, my firm offer that. It's beneficial, but it hasn't helped me as much as the books. What else? bit of a loss there. I'm a bit blank.
No, that's enough. That's enough. That's three. How do you recover your energy? What do you do for downtime?
I'm very good at switching off. You know, I think, you know, sometimes like on a weekend I go home, I might be thinking about it on Friday nights and stuff like that. But definitely by the time I wake up on Saturday morning, I've just totally forgotten about work.
Okay,
I've switched off. It means that it's a high stress job, and it could,
yeah,
shorten your life. But if you're able to switch off, right, you're able to recover. It's a bit like, when you're an athlete, you train hard, but you need recovery time.
Mm-hmm.
And so if you aren't able to switch off, it takes its toll. I mean, that's not the way a lot of people, I've seen tons of people, when they go on holiday, they're on their Blackberries constantly and, checking up on the markets and, still doing their job 24/7. And maybe that's for some people, it's not for me. It's not the way I've been. I've been consistently profitable, every year for a very long time. I've learned to, I add value in the way I do, and it doesn't require me to be there 24/7 following markets. I'm very relative value oriented. And so, for me, being able to just switch off at night and forget about it, the next morning when I wake up, going out the door, sort of opening the door to walk out the door is suddenly when it sort of switches back on, and suddenly I start worrying about something, or, also anticipating a good day or what have you.
Yeah.
So that really helps.
Is there a trick to that, or is this just something that is natural to you, or have you trained yourself to become that way?
Being Jamaican, I don't know.
Yeah, fair enough. Yeah, it's in the blood. Fine. Okay, and last one from me then. Who's your role model and why?
Nowadays, I'll think about the nowadays one. I mean, originally, so when I was at school, my role model was a physicist called Richard Feynman, and he won a Nobel Prize for physics. And what I loved about him was he was extremely bright.
Mm-hmm.
He had a very, very straightforward and easy way of explaining things, but he also he had interests well outside of physics, across, that spanned, the entire knowledge base. And he was just an interesting person and a character. And that's what got me interested in that. In terms of role model of what I do now, actually, I think probably the guy I worked for very first time when I started at Chase, a guy called Rob Crampton. He was a bookmaker. I think it was at William Hill. And Chase, or Chemical Bank, in fact, thought that, they wanted to find people who were good at, handling, risk managing. And they thought that bookmakers would be a good place to recruit. And he came to be a trader. And he essentially taught me that it was all about the numbers. And this is what I say to, students who come and interns and what have you to find out about what I do and what it is. I sort of say it's simple. It's just for me, it's just numbers. It's 1, 2, 3, 7, 8, 9. What seems odd about that? It's sort of like, well, the 3 looks a bit low, the 7 looks a bit high. And that's what he taught me. And I think that's what I've built my entire business model around. And it means that I've been able to, I think, profit in whatever situation. What I am not is I'm not great at working out, what's going to happen in the economy. I couldn't tell you whether non-farm payrolls is going to be high or low, right? What I really do, I make money by saying, okay, I'm going to bet on the cheap bets for it being a high number, and bet on the other way on the expensive bets, so for it to be a low number, as it were. And so I have lots of different parts of the curve, provide liquidity in the curve and get a position which essentially over time reverts to what I think is the correct, 1, 2, 3, 4, 5, 6, 7, 8, 9, as it were. A smoother curve, something that makes more sense. And I guess he taught me that. And that's what my entire business model has been based on.
Nice, good. So it's a nice way of saying thank you.
Yeah, I guess so.
Cool. Okay. Well, Alaistar, it's been a pleasure. Thanks for joining me and sharing your insights.
Thank you, Martin. It was fantastic chatting.
Yeah, really appreciate that. If anyone's listening, they want to pick your brains on anything we discussed, I assume you're okay for people messaging you on LinkedIn.
Absolutely. Yeah. No, I talk to a lot of people on LinkedIn, especially about LIBOR, but other things certainly too. And in fact, not to I don't want to be deluged with messages, but if that happens, so be it. I'll try my best to answer people and help out.
Absolutely, thank you. To the listeners, thanks for tuning in, and I hope you enjoyed listening. I certainly enjoyed it. So please pass the pod, and obviously we'll get more people involved. Thanks a lot.